Okay, so you've seen the headlines, right? The phrase, no tax on tips, is literally everywhere right now. It's this massive, highly discussed new U.S. tax change that has everyone talking. But what does it actually mean for the hardworking people who rely on those tips to pay rent? Today, we're going to cut right through the loud sensationalism and look at the actual facts. We're going to break down the source material step by step in this explainer so you walk away with a crystal clear understanding of the real mechanics behind this policy.
I want you to start by just picturing this for a second. What if I told you that in 2026, you might not pay federal tax on your tips? Just imagine that scenario. It sounds almost too good to be true for millions of workers, doesn't it? It is an incredibly catchy slogan for sure. But as we know, when it comes to complex tax policies, we really have to look past the slogans and see the gears turning underneath. Well, here is the massive anchor number standing at the very center of this whole thing, 25 grand. Under this new U.S. tax change, eligible workers are allowed to deduct up to $25,000 of tip income from their federal taxable income. Now that is a substantial figure, and it completely forms the foundation of the financial relief we're looking at today. To put that into perspective, think about your favorite weekend server or a barista at a packed downtown cafe. For a lot of folks in the service industry, $25,000 covers a massive chunk, if not the entirety of their annual tip income. By setting the limit right here, the policy aims to capture the vast majority of everyday tipped wage earners. It's not unlimited, but it's a highly calculated figure designed to maximize impact for the people who actually need it most.
All right, let's jump straight into part one, the sensational tax headline, myth versus reality. So there's this massive myth floating around out there that this headline means complete 100% tax avoidance. And honestly, it's pretty easy to see why people think that, right? No tax sounds pretty absolute. But the reality is quite different. What we're actually looking at is a tax deduction specifically on your federal income. You do not completely wipe your slate clean of all taxes. That simply isn't how this legislation is written. The reality is that you may pay much less federal income tax on your tips, up to that $25,000 limit we just talked about. Say you earn $30,000 in tips, for example. That final $5,000 is still fully subject to the standard federal income tax rates. It's a vital distinction that separates a loud political slogan from the actual actionable tax code.
Which brings us nicely to part two, how the deduction works. Let's get into the mechanics.
Let's define exactly what we're dealing with, directly from the source material. This is what's known in the biz as a targeted tax deduction. And the keyword there is definitely targeted. This means it's a policy meticulously designed to help tipped workers keep more of what they earn, rather than being a full sweeping tax elimination. Because, let's be honest, we are talking about the IRS here. They rarely let anyone completely off the hook. By using a targeted deduction, the government gets to offer significant financial relief while keeping the underlying structure of the tax system intact. Grounding our expectations in this exact definition, a specific, calculated deduction rather than a magical erasure of all your tax liabilities, is absolutely crucial if we want to grasp the real-world impact of this thing. Moving on to part three, who actually qualifies? The eligibility rules.
This is where I get really enthusiastic because this is where the policy becomes real for millions of people. Who actually gets to take advantage of this? Well, you've got to clear three specific hurdles. First up, you must work an eligible job. The text explicitly highlights servers, bartenders, delivery drivers, and hospitality staff. Think about the delivery driver logging late-night miles or the hotel housekeeper. These are the intended beneficiaries. Second, your overall income has to be under the set limit, which sits right around $150,000 for individuals. This threshold is incredibly important. It acts as a protective measure, making sure the policy actually helps the middle and working class rather than becoming some loophole for executives to reclassify their big bonuses as tips. And third, please do not miss this one. Your tips must be reported properly. This explicitly includes both cash and card tips. So if you're a bartender, making sure your cash tip envelope perfectly matches your reported income is going to be more critical than ever. You simply cannot claim a deduction on tip income that isn't properly documented in the system in the first place.
So when does this whole shebang actually kick off? The policy applies when you file your taxes for the 2025 to 2026 tax season. Now, I know that might sound like it's a little ways off, but this timeline is highly relevant to your life right now. Why? Because the financial habits you build today, like meticulously tracking and reporting those tips, are exactly what will save you money when you sit down to file your returns in early 2026. Preparation is literally everything here.
All right, part four, the hidden tax catch. Time to read the fine print. Because there's always a catch, right? Here is the fine print that the catchy slogans conveniently leave out. While your federal income tax is indeed reduced under this policy, you are still absolutely on the hook for payroll taxes. Yep, you still pay Social Security taxes, you still pay Medicare taxes. And importantly, depending on where you live, your state taxes might still apply too. This is a massive distinction. Payroll taxes for Social Security and Medicare eat up roughly 7.65% of an employee's paycheck. For a service worker relying heavily on tips, that is a highly noticeable chunk of change that will just continue to be deducted, business as usual. Because this is a deduction and not a full elimination, those foundational tax obligations, they do not just magically disappear.
Finally, Part 5, the real-world impact. Let's look at your bottom line.
This is the ultimate real-world takeaway from the source data. If you navigate this policy correctly, it could mean saving anywhere from a few hundred to a few $1,000s in taxes every single year. Let's bring this to life with a hypothetical scenario. Imagine a hospitality worker pulling in $40,000 a year, with about half of that, $20,000, coming directly from tips. Under this new policy, by deducting that $20,000 from their federally taxable income, they could be looking at keeping a few thousand extra dollars in their pocket at the end of the year. Depending entirely on your total income and the specific amount of tips you've earned, this targeted deduction actually provides very meaningful, highly tangible financial relief. It might not be the total tax wipeout the headlines scream about, but an extra $2,000 or $3,000 for a working family, that's an incredibly impactful reality.
So, I want to leave you with this final, crucial question to chew on. How will a targeted deduction change your bottom line in the 2025-2026 tax season? Knowing that you absolutely must report your tips, every dollar, both cash and card, knowing you have to navigate that $150,000 income threshold, and knowing you will still be paying Social Security and Medicare, how does this detailed reality shape your financial game plan moving forward? Keep the mechanics and the facts we've covered today in mind, build those good reporting habits right now, and you will be super well prepared when tax season rolls around. Thank you so much for joining me on this explainer, and keep learning.